Hi everybody, let's get started. An item of inventory was purchased for $500. It's expected to be sold for $1,200, although $250 will need to be spent on it in order to achieve the sale. To replace the same item of inventory would cost $650. The key point in this question is, in the first place, we need to define cost, NRV, and replacement cost. So let's do it. The only amount in this question which we may accept as cost is only purchase price, $500. $500. Net realizable value. First we need to find expected selling price, which is $1,200. And hereafter we have to deduct expected selling costs from this amount, which is $250, to find net realizable value, which gives us $950. Replacement cost is already given, $650, which is prohibited by IFRS. Therefore, we are not going to take this into account. According to IAS 2, we must opt for lower one in terms of value. Therefore, the correct option has been chosen as $500. Well, now it's time to elaborate on the question number 90. Closing inventory may be valued using first in, first out or average cost methods. Okay, which of the following statements is true, assuming that prices have fallen throughout the year? Okay, let's look. As you can see from this example, each of the methods, first in, first out, average cost cumulative, average cost periodic, each of them applied to the same period, same purchases and same sales, as you can see from this example. And now pay attention to this column. These are inventory purchase prices, and these prices have increased during the month. And now we can say that this is the period of rising prices. And in this state, when we use first in, first out method, we get 70, and when we use average cost cumulative method, we get 65, and when we use average cost periodic, we get 60. Therefore, in the times of rising prices, if we use first in, first out method, if we apply this to closing inventory valuation, we get higher closing inventory, and by virtue of this, we get higher profit margin. In addition to this, when the price is falling throughout the year, the situation will be quite opposite. So let's give it a try. I want you guys to testify to this. Now let's change these price numbers from higher to lower. And hereafter, the lowest figure is 50 when first in, first out method applied, and the highest figure is 60 when average cost method applied. As a conclusion, I have drawn this chart for simplicity. Well, now let's back to the kit and opt for the right one. As we can see, this is the period of falling prices in question, and we have already mentioned that when the prices fall throughout the year or period, the closing inventory and according to this the profit become lower when first in first out method is applied rather than average cost method. In this case, it doesn't matter which average cost method they have applied, because any of them is higher than first in first out. Therefore, we opt for the option B. Appleby buys and sells inventory during the month of August or as follows. We have some sales, purchases here. The question is, which of the following statements is true? Using first in first out method and periodic weighted average. In each option, comparison between first in first out and periodic weighted average cost method are required. Therefore, we must apply both methods in one way or another. Well, now let's do it. As you can see here, it doesn't matter which method you use. In both cases, only 150 inventory items last. Now let's compute with first in first out method. At the beginning of the period, we have 100 units. After selling 20 of them, remaining inventory items is 80, each for $2.52. Afterwards, we have purchased 140, each for $2.56. Then once again, the business sells 90 of these, and the remaining inventory units become 50. Sorry, let's correct this. Not 50. 130. And of course, each for $2.56. Which means, according to first in first out method, 130 are the units which were in 140. Let's resume in this way. After final purchase and final sales, only 150 units remain. In the same way, each unit for 2.78. The last purchase price. And the total closing inventory is 417. In addition to this, let's compute the same figures with periodic average cost method. We must add up all the purchases and opening units, and also total prices as well. To make this is $440, and the total prices $1,166.4. The average cost figure is, after dividing this by 440, gives us 2.65. And after multiplying 150 by 2.65, closing inventory, as you can see, is 397.64, and the difference between these two is 19.36. When we compare these two figures, first in first out method becomes by 19.36 greater than average cost periodic. 19.5 is a closer figure to our conclusion rather than 17.5. For this reason, we must focus on these two options, and we opt for option A rather than option B, because this is completely opposite to our approach. 3. Identify whether each of the following statements relating to the accounting treatment of inventory and work in progress in financial statements is true or false. Okay, let's read each of the narratives and decide if they are true or false. Inventory should be valued at the lower of cost, net realizable value, and replacement cost. Stop right there until this part. The statement is true, but the replacement cost corrupts it. Why? Because it's prohibited by International Accounting Standard 2. It's prohibited from use. Therefore, the first narrative is false. Let's move on to the next one. When valuing work in progress, material costs, labor costs, and variable and fixed production overheads must be included. When valuing work in progress, material costs, labor costs, variable, fixed production overheads, that's absolutely true, must be included. Yes, it seems okay. Let's move on to the next one. Inventory items can be valued using either first in, first out or weighted average cost. This is also true. An entity's financial statements must be disclosed the accounting policies used in measuring inventories. And the last one is also true. I do not consider that. You may find it as tough question, so I don't think any further explanation is necessary. Well, now one of the toughest questions regarding inventory in KAPLAN exam kit. To conclude this question, we need to adopt a little bit different approach. Well, let me show you. And in this Excel file, you can see basic and simple financial statements, statement of financial position, statement of profit or loss. But the question number 94, but the narrative of question number 94 hasn't been applied to the solution yet. Therefore, both of the true and false versions gives the same result, as you can see. Well, now let's firstly add our values in true version, which means we will make calculations as it should be. And in addition to this, we will do the false computing, which is the actual one as well, and compare the results. Well, firstly, let's read the narrative and apply. Kira's interior design business. I also know one of the most famous anime characters by the same name. Right, so let's get on with the lesson. Kira's interior design business received a delivery of fabric on the 29th of June 2016 and was included in the inventory valuation at the 30th of June 2016. As at 30th of June 2016, the invoice for the fabric had not been accounted for. Based upon the available information, what effect will this have on Kira's profit for the year ended the 30th of June 2016 and the inventory valuation at that date? Well, as we know from the above information, there are two transactions happening at the year end. One of them is credit purchase, and the other one is inclusion of this purchase in closing inventory. Let's say this purchase price is 100 and give the double entries. When the first transaction occurs, double entry must be like this: debit purchase 100, credit payable 100. On the one hand, it increases our our cost of sales. On the other hand, it increases our payables by 100. And when we count this as closing inventory, the double entry must be debit inventory credit cost of goods sold or cost of sales by 100. On the one hand, it decreases our cost of sales by 100, which increased cost of sales with the same amount before. Now we decrease it by 100, the same amount, which means we have not been able to sell this inventory. Okay, on the other hand, it increases closing inventory in statement of financial position and current assets in inventory. Okay, this is the way as it should be. This is the most proper estimation of this calamity. But the actual approach to this calamity is not the case. The problem is Kira has omitted record for invoice, which means the first double entry has not been recorded absolutely. And when we apply only the second one, the conclusion becomes like this. Well, now let's compare these two. As you notice, closing inventory becomes higher when you don't record for invoice. Furthermore, inventory becomes the same. It doesn't change because it's been included in inventory valuation because of this double entry. Well, now let's read each of the following and decide if they're right or wrong. Profit for the year ended will be overstated. As you know, it's true. Profit becomes higher when you don't make a correction. Inventory will be understated or inventory will be overstated. Inventory doesn't change, therefore both of these statements is not accepted. The last one, profit for the year will be overstated, but next year's profit. Well, this year's closing inventory is the opening inventory of the next year. Therefore, it should have opposite effect on the next year's profit. This means if current year's profit is overstated, then the next year's profit should be understated, not overstated. That's why this one is also not acceptable. The only correct option is the first one. I hereby pronounce option C as the correct option. What journal entry is required to record goods taken from an inventory by the owner of a business for personal use? Well, one of the common mistakes that students make is considering that if in the narrative it's given that goods taken from inventory, then it's all about inventory account, but they have got one part of that wrong. Purchases are inventory as well. And as a basic rule, when goods taken from inventory, we will exactly credit the purchase account. Never credit inventory. And now let's see how it works in the financial statements. When we credit purchases, e.g., for example, for instance, by 200, cost of sales decreases and net profit increases. And on the other hand, we'll increase drawings by 200 as a negative amount. You may ask why drawings are negative in the equity. Because when you record debit amount on the credit side, or when you record credit amount on the debit side, it becomes negative. It is based on accounting equation. We opt for option A by virtue of this reason. Question number 96. A business had an opening inventory of 180 and a closing inventory of 220 in its financial statements for the year ended. Which of the following accounting entries are required to account for opening and closing inventory when preparing the financial statements of the business? It's actually one of the easiest questions that I have ever met regarding inventory. You may also open study text, see the correct double entries, and opt for the right answer. But nonetheless, I would like to mention opening inventory represents the movement from inventory account to cost of sales, and closing inventory represents the movement from cost of sales to inventory account. So when it comes to opening inventory, you should credit inventory account for decreasing the amount in inventory and debit cost of sales to increase cost of goods sold. In the same way, we're gonna do the same thing for closing inventory, but with opposite double entry. By virtue of this approach, we credit by 180 inventory account and debit cost of sales, which is included in statement of profit or loss, and debit inventory account, credit statement of profit or loss by 220. AG's annual inventory count took place on the 7th of July 2016. The inventory value on the date was 38,950 during the period from the 30th of June 2016 to the 7th of July 2016. The following took place: sales by 6,500, purchase 4,250. The markup is 25% on cost. What is AG's inventory valuation at the 30th of June 2016? Let's make this clear. On the 7th of July, we had inventory only by 38,950. But this is not the year end. This amount comes from the next year. We need to find the correct inventory amount on the 30th of June 2016. To make this, we determine that how much inventory come and go between these two dates during this small period. Okay, let's see. Sales have occurred by 6,500 and purchase have occurred by 4,250. It's clear that purchase amount represents the input amount. but the sales figure doesn't represent the output amount. To make this, we need to convert this amount to its cost of sales. And one of the data that we must take into consideration is the markup of 25%. Well, let's convert this. Cost of sales and divide this amount by 1.25, which represents the output of inventory during these 7 days. And the last part of this is a basic equation like this: closing amount minus this one minus this one. And that's it for this question. Question number 98. Inventory movements for product X during the last quarter were as follows. Opening inventory at the 1st of January was 6 items valued at $15 each. During the following months, given the following details, we must obtain the gross profit for the quarter by valuing inventory using the continuous weighted average cost method. To squander your time, I will draw its table promptly. In this table we have date column, units column, price per unit column, total price column, sales price column, and gross profit column. Details of opening inventory, purchases, all purchases in different times and sales in different times are given along the rows. According to continuous average cost method, we must obtain average cost at each time purchase happens, but the same doesn't go for sales. Well, let's do it. Firstly, we add total prices and total units and hereafter we divide total price by total units. The cost of sale for each product when goods are sold becomes this average cost value. The total cost of sales becomes 174, and the total sales price becomes 300, and the gross profit from the sales becomes 126. After selling 10 of the units, 10 inventory units remain at the average cost value. I don't want to waste your time, therefore I will do the rest of the calculations by myself. Continuing in the same way, we will have 165 gross profit. But before this, let me mention that I have made a little mistake. I have started with 10 of inventory units, but if we replace this with 6, the gross profit amount automatically becomes 155. Your firm values inventory using the periodic weighted average cost method. At the 1st of October 2018, there was 60 units in inventory valued at $12 each. On the 18th of October, 40 units were purchased for $15 each, and a further 50 units were purchased for $18 each on the 14th of October. On the 21st of October, 75 units were sold for $1,200. What is required is the closing inventory at the end of the period. To squander time, I have already set the table. Periodic average cost method is the easiest one because it requires calculation only once. All we got to do, firstly, adding all the purchase units, 60 plus 40 plus 50, but this one is not purchase, this is actually sales. Okay, total purchases, total purchase units, and let's obtain total price of purchases. Total price of purchase, 720 plus 600 plus 900. The average cost value is, it becomes $14.8. After selling 75 of 150, the remaining inventory becomes 75, which is the closing inventory units, and each of them should be valued at $14.8. The total closing inventory value therefore becomes 1,110. Percy Pilbeam is a book wholesaler. On each sale, commission of 4% is payable to the selling agent. The following information is available in respect of the total inventories of 3 of his most popular titles at his financial year end. This is cost column and this is selling price column, which could be considered as expected selling price. The first title is Henry VII, Shakespeare, so and so, so and so. Let's refer this one as first title, second title, and the third title. And of course, I have already set table for solution, and I added 3 more columns: selling expenses, net realizable value, and the amount inventory which inventory should be valued at. The selling expenses should be the 4% of expected selling price for each of the following titles. Therefore, it will be easy to obtain it. 4% multiplied by 4%, each of them. Well, now let's figure out the NRV prices. NRV price should be equal to expected selling price minus expected selling expenses for each of the following titles. And the final part is to compare cost and NRV prices, cost and NRV values. The lower one should be opted for. For the first title, cost is lower. For the second title, NRV is lower. For the third title, NRV value is a little bit lower than the cost. Thereby, the closing inventory, total closing inventory, must be valued at $7,368. Well, one more inventory valuation question. The required method is first in first out method. This type of questions becomes easier when we solve them by means of Excel. Given the whole data, let's find out the value of closing inventory at the end of the month. Okay. Opening balance is 15 units, each at $3. Total price is $45. After selling 5 of them, the remaining balance becomes 10 units, each at $3. Total price is 30, and afterwards 10 items are purchased and 8 items are sold. After purchasing 10 and selling 8, the remaining inventory becomes $12. The closing inventory units should be separated. Firstly, 2 units out of 12 must be valued at $3, and the rest 10 units must be valued at $3.5. Thereby, the total closing inventory value becomes 41. $41. According to the principle of first in first out method, before selling 8 of these 20 inventories, it is decided in the first place to send to customer these 8 units out of these 10. What would be the effect on an entity's profit for the year of discovering that inventory with cost of $1,250 and a net realizable value of $1,000 had been omitted from the original inventory valuation? Let's be cautious. Do not act hastily. Ponder the problem. Do not skim through the narrative. Be patient and probe deep into the question. As mentioned in the question, if you discover some inventory subsequently, it means that the discovered inventory has not been included in the original inventory valuation. It's been emphasized once again in this part of the sentence. Let's say before finding this inventory, the original inventory worth 5,000. Double entry should be debit inventory, credit cost of sales, cost of goods sold by 5,000 and 5,000 minus 5,000 from cost of sales, deduct this amount and add this amount to inventory. And let's see what happens when we discover additional 1,000 inventory with cost of 1250 and has NRV value by 1000 as well. As we know from the past practice, the lower value should be opted, and when we do that, look what happens. We will decrease cost of sales by 1000, and indirectly net profit figure increases by 1000, and also inventory figure increases by 1000. In conclusion, we have 1000 increase in net profit. That's it. Question number 103. Just a simple NRV question. Given the following information, I have made this table and added one more line for NRV price. Let's compute NRV value for each of these products. 9 minus 1, 12 minus 4, 15 minus 5. The next step is choose the lower one from these two for each of the products and multiply it by the number of units. Let's do it. For basic, it's 6, multiply it by 200. For super, it's 8, multiply it by 250. For luxury, it's 10, multiply it by 150, and the total closing inventory amount will be $4,700. In times of rising prices, the valuation of inventory using the first in first out method as opposed to the weighted average cost method will result in which of the following combinations? Okay, let's back to my example. As we know from the past practice, we get higher amount of inventory by using first in first out method rather than average cost method in times of rising prices. Therefore, closing inventory becomes higher. In accordance with this, profit figure becomes higher as well. But when it comes to the cost of sales, see, look what happens when we obtain the total cost of sales figure from this sales, this and this sales. By using first in first out method, we get only $290 of cost of sales, but any of the average cost methods gives us a higher figure than this. Thereby, in terms of rising prices, using the valuation of first in first out method rather than average cost method, we get higher closing inventory, higher profit, but lower cost of sales. If an entity uses the periodic weighted average cost method to value closing inventory, which of the following statements is true? The main difference and the simple side of periodic average cost method is it requires calculation only once. But when we use a FIFO or continuous average cost method, we must recalculate each time purchase or sales happen. Thereby, the only proper answer is option C. But as long as average cost, continuous weighted average cost is concerned, calculations must be made each time purchases happen, not sales. Let's search for the correct answer. Each time in the option D. Each time, okay, there is a purchase or sale. No. Each in the option C. Each time, okay, in a sale of goods. No. Option B. Each time, only once. No. Option A. Each time there is a purchase of inventory. Right. Hereby the correct option is A. Tests questions from 107 to 110 are all of them require calculations which we have made before. That's why I don't see the need for doing these. I commend these questions to your care. I hope you will enjoy finding answers to these questions by yourself. Well, thanks for watching my video up to the very end.